you for coming today. We have an audience online here. This is simulcast onto Zoom at the same time we do this. So we want to be prompt and honor everybody's time. This is the 2024 annual economic update. We're going to look back at the year 2023 in several areas, and we're going to look forward to 2024. I want to introduce, first of all, the team. My name is Guy Lehman. I'm an owner and advisor here. Welcome. Thanks for coming. Caleb Pearson is running the show here. Thanks, Caleb. Justin Van Houten, Steve Connard, Michelle Bjorkren, Alan Holstein, and Mandy Rhodes. Those are our advisors. On the admins, we have Nancy Economist, Joe Waniger, Cheryl Hurst, Julie Greer, and Hannah Mason. And Kurt, I can't forget Kurt Pearson. Thanks for coming, Kurt. Yeah. I want to introduce Dan Holtkamp from JP Morgan. Dan has been a long time contact with JP Morgan. We rely on him pretty heavily for economic insight, update JP Morgan's outlook. He's going to talk about two things specifically. We're going to look back at 2023 economically, and then we're going to hear what JP Morgan thinks 2024 holds in store for us economically from the economy perspective. And we're also going to look at financial markets in 23 and also what JP Morgan's outlook is for financial markets 24 going forward. Dan, take it away. Thanks.
Thank you, Guy. Can everybody hear me okay? Wonderful. Well, thank you very much for the opportunity to be here. Guy, thank you for that nice introduction. And I want to thank the entire Compass team. I think everybody should feel really good. Those of you that are in the room, the amount of time that this team spends on analyzing markets, being thoughtful around the different investment strategies that you're using. While you would expect that to be commonplace in the financial services industry, it's not always that way. And so I think for those of you that are here, those of you that are on the Zoom, I think you're in the right room. You're working with the right team that has a plan and acts with integrity. And those are two things that I look for when I'm working with top teams across my territory. Teams that have a plan and teams that act with integrity. And I think that the Compass team definitely does that. So now that I went through that, just maybe a couple comments. As Guy said, my name's Dan Holtkamp. I'm a client advisor with JP Morgan Asset Management. I'm going to share our outlook for what we saw last year, but also moving forward on both the economic environment, but also the market environment. And so to kind of tee it up, I was thinking about what I wanted to talk about. And we just got through these 20 inches of snow over the last week or so. I think we're supposed to get a couple more here, and not uncommon place for Iowa. But I was thinking about over the weekend, I took my family up to Afton Alps up near Minneapolis. Minneapolis had 1 inch of snow all year. And we decided to go skiing in Minneapolis and avoid the 12 inches of snow that we got here in Des Moines. And the reason I'm telling you this is it was unexpected. It wasn't what we thought was going to happen, but actually it turned out to be an incredible weekend. And if you think back to 2023, almost every economist, all the smart people on TV said recession is coming and it wasn't going to be a good year for markets. We saw more money in 2023 move into cash and money markets and CDs than we saw in 2008. And if you look at how that worked out, outside of commodities in 2023, cash was the worst performing asset class. Almost everything else did better. And again, while it was unexpected, just like the 12 inches of snow we had here in Des Moines versus the 1 inch in Minneapolis, 2023 actually ended up being a pretty good year for financial markets. So I'm going to touch on that a little bit more, but just to set the stage, I want to talk about the economy, where we've been and where we're going. And then I'm going to transition to more on the financial markets because they are separate. Because sometimes when you turn on the TV, you hear things around inflation, the federal debt. You hear things about people working or people not working. And I think sometimes that can distort the outlook of what's actually happening. And so when we look at the economy, this gray bar here is economic growth in the US, and you can see the line continues to rise. And I think despite what you may hear on the news, if you look at GDP or gross domestic product, it's at an all-time high. It's not only at an all-time high, but this is where we were pre-COVID. The economy has grown by over 20% since where we were before COVID. And so the economy is strong. Yes, we're dealing with continued inflation. Yes, we're dealing with higher levels of debt, but the US economy is the world's largest and strongest economy in the world. And that all is because of you all here in the room. It's because the consumer. 70% of the US economy is due to consumption. And the one thing we know, or one thing economists know, is Americans are really good at one thing, and that's spending. Spending money. And while the Compass team, from a planning perspective, would probably not like you to take on too much credit card debt or another mortgage or a home equity line of credit, a lot of consumers have done that, and not maybe too high, but the consumer spent a lot more money than I think a lot of people expected in 2023, and that's what propelled the economy forward last year. And while we expect that to slow this year, the consumer is in still really strong shape. The reason for that is unemployment rate, which is the gray line here, peaked at nearly 15% during the pandemic. It's all the way down at about 3.5% today. So there's still job openings. Many Americans still have good jobs. Again, some people are it's a little bit of a struggle with prices going up and wages maybe not rising quite as fast in some sectors, but we have seen wages go up in many parts of the economy, and so the consumer is in pretty good financial health. The other factor that plays is, well, interest rates have gone up on credit cards and mortgages. You might have heard the news that credit card debt is at all-time high. I mentioned consumers are spending, but again, there's some concerns there, but I think you've got to put that in perspective. When we look at credit card debt, mortgage debt, auto debt, those numbers are up a lot in the last 3 years. But put those numbers in perspective over the last 40 years, consumer debt relative to income is still near the lowest it's been in the last 40 years. So it's up in the last 3 years, but that's up because it was at such a low level during the pandemic. Consumers weren't spending as much, and they were getting more income. And so that kind of artificially moved that number lower. But here's where we are today, about 10% of debt to income. Back in 2007, we were at nearly 14%. So the numbers are down a lot, which means, again, consumers are spending more, they're taking on more debt, but relative to the income they have, it's still in a very manageable position. Now, that's not for everybody across the economy. Again, this is kind of more macro. It's not an individual update. It's more economically across demographics. The one area we're starting to see some signs of stress and why we think the economy is going to start to slow in 2024 is when we look at things like auto loan defaults, credit card defaults. Those are the highest we've seen in 10 years. And so especially the lower third of Americans in an income percentage, those Americans have spent through all that extra cash they had from COVID. And with higher prices at the grocery store, their income hasn't, counteracted that. Before our ski trip, I packed a sandwich. So instead of buying, the overpriced hot dog at the ski slopes, I went to Hy-Vee and grabbed some sandwiches and grabbed a couple bags of chips. Paid $5.99 for a bag of blue Doritos. I bought it because my son loves Travis Kelce, the tight end for the Kansas City Chiefs, and so he wanted that. But $5.99 for a bag of Doritos. Now, again, that doesn't sound like that much, but I think that's doubled in the last couple of years. There's some grocery stores in Europe that have totally pulled PepsiCo products because the prices have gone up so much. And so, again, the point here is prices are up a lot. Consumers, especially the lower income individual, are really starting to struggle, and you're seeing it in defaults. The orange line here is student loan defaults. Those numbers are still low, but again, those payments are just starting to come back on board. And so, again, bottom line here I want to make, if I can just summarize it, the economy is good. It's not great. It's still growing. And in 2024, barring some big shock, whether it's a recession or it's a major geopolitical event that we don't expect or major increase in the price of oil, we expect good economic growth and not a recession in 2024. Part of the reason we think that is while prices are high, inflation is coming down, which gives the Federal Reserve, which we'll talk about here in a few minutes, the ability to start lowering rates. Just about a year ago when I was here, inflation was over 7%. Inflation's down to 3.4% today. Now, let me clarify what that means, again, because those prices of things we're buying, they continue to go up, right? But the rate of change isn't going up as fast. And so if you buy a gallon of gas for, let's say, $3, like it was a few years ago, and it goes to $4, what's the inflation rate in that gallon of gas going from $3 to $4? Any good mathematicians in the room? 33%, thank you. Now, if the gallon of gas goes from $4 to, let's say, $4.25, that rate of change isn't as much, but it's still going up, or maybe it just stays at 4. At the end of the day, they would say the inflation rate going from 4 to 4 is 0, but if it still costs me $80 to put gas in our Suburban, that's costing me a lot of money. And so that's what we're seeing with inflation. The prices aren't going up as fast at the grocery store, at the fuel pump, on mortgage rates, or airline fares, but they still continue to go up. And the bottom line here is, while cash is paying close to 5% today, with inflation in some sectors at 4 or 5 or north of 5, if we're not getting our money to grow fast with that inflation, we're going to see the price of that bag of Doritos or the price of that ski lift ticket or that vacation you want to take continue to go up in price. And so while the rate has come down, prices continue to go up. The point here, though, as the rate comes down with good unemployment and inflation approaching that 2% level, that gives the Federal Reserve that ability to kind of take their foot off the brake. They've raised rates to a really high level, north of 5%, from just where it was 2 years ago at 0. They're pushing their foot on the brake to try to slow the economy as much as they can without putting us into recession, but to try to get rid of the inflation. What they expect to happen this year is rates down. They're going to not cut rates to 0 like it was, but lower rates and eventually start to see rates come down. The market, though, has been really excited here over the last month or two that rates are going to go down significantly. But again, we don't see the economy falling apart and really the warranting of rates going down significantly. And so I think the point we would make here with interest rates is they are probably expected to come down in 2024, but maybe not as quickly as the market's expecting, because the economy is strong and we don't see a recession on the horizon. So what that means for investors is maybe CD rates and money market rates you might just see start to come down, and we've already started to see that. For equities in the stock market, stocks could still do well in that environment, especially if there's not other alternatives that are really strong. And I think fixed income could have a good year in 2024, because if you're getting bonds that are paying 5% today, if 6 months investors think that rate is going to be 4 or 3, there's a lot of demand for those bonds today. And so again, generally speaking, good economic growth, the consumer's strong, with inflation and interest rates coming down, that's a pretty positive backdrop in our view for 2024 and beyond. The implications for that, for the financial markets, so let's switch gears a little bit. Let's talk about the implications for bonds, and let's talk about the implications for stocks. 2020, the last 3 years actually was one of the worst environments for bonds we've seen in over 200 years. 2021, bonds lost 2%. Now you think about that, it doesn't sound like that big deal, but look at the last 50 years. The gray bars show how bonds did for the full year. In almost every single year, bonds make money. Not as much as stocks, of course, but there's not very many years, actually 1, 2, 3. 3 years and 50 years prior to the most recent, the bonds lost money. Bonds almost always go up. Although in 2021, they went down 2%. In 2022, they went down 13%. That was the worst year in 250 years. And then for 2023, they were down for most of the year until December. And what changed is interest rates went from 5% to 4% really quickly. And the reason for that is the market's expecting that the Fed starts to pull back from all these rate hikes they've been doing because inflation is moderating. And so, again, bottom line, it's been a really challenging environment for anything in fixed income. But the good news is because we're close to that point rather, where interest rates aren't going to be going up as much, but rather going down. The good news is twofold. Number one, these bonds you're getting, you still have a high yield, 4, 5, 6%. In reality, that's the best we've seen in 15 to 20 years. And that's a big reason you buy bonds, is for income. The second thing we're seeing within bonds is as interest rates start to come down, you should see some price appreciation from those bonds. Remember, bonds are just math. They're either going to mature at par or they're going to default. Remember, bonds are like a loan. You give a company or a country money for a set period of time. Over the course of that period of time, they're going to give you some money along the way. And after 5 years or 10 years, they give you your money back. You're essentially being the bank. You're loaning that company or country money. But if interest rates go down and you own those bonds that are paying 5%, imagine if this side of the room had a bunch of bonds that were paying 5%. And all of a sudden, interest rates went to 3%. And this side of the room wanted to buy bonds. Do you want to buy the new bonds that are at 3%? Or do you want to buy this bond over here that's at 5%? Right? You're going to want to buy their 5% bonds. But if all you can get is 3%, they're not going to sell it to you at a good price. They're going to sell it to you at a premium. And that's where we're at today. As interest rates have started to come down, you started to see bond prices go up. We don't know how quickly that's going to happen, but if you look at the blue bars, this shows you the upside you could see in different fixed income sectors. The gray bars is the downside. Now there's one outlier here, and that's long-term 30-year treasuries. Again, you could lose a lot, but you can make a lot. If you take that one bar off, the bottom line with this is there's very little downside left in fixed income and just a lot more upside. So I can't give you a recommendation if bonds are right, but I do want to make the point, after 3 years where bonds have essentially made no money, we do think moving forward, bonds are an important part of a portfolio to get good, consistent income, but also add some stability to portfolios as we move further into this economic cycle and there's more uncertainty. So don't abandon bonds. Bonds still have a place in portfolios. Let me talk about the implications to the equity markets. Again, we've had a good economy. We had a great year in US stocks. Stocks were up 25% last year. Now, I just want to back up a little bit. It's been a roller coaster over the last 3.5 years since COVID. Back in February of 2020, when we kind of started to see the downturn in COVID, the stock market was down 35%. And then it was up 100, then it went down 25, and now we're up about 30% since then. That's been an up and down roller coaster, of course, but since the beginning of COVID, the stock market's up almost 50%. You think about all the bad things that have happened, all the reasons that the media told you to get out, it can't possibly go higher. Just think about that. The fact the market's up almost 50% over that period of time, that's pretty amazing and a testament to what you're buying when you're buying the stock market. You're buying companies, you're buying shares of these companies. I didn't like that I had to pay more for that bag of Doritos, but the company behind that, PepsiCo, they make more as those prices go up. And so we can complain about the prices, or we can buy those companies that are benefiting from those higher prices. Now, while the market's up a lot, not just in the last 3 years, but also it was up a lot last year. The stock market was up 26%, including dividends last year. But if you look at the top 10 stocks, really what drove the market performance wasn't that everything was doing well. It was the top 10, or what sometimes people call the Magnificent Seven. Has anybody heard the Magnificent Seven? Yeah, so the Magnificent Seven, these are the big stocks like Apple and Amazon and Tesla and NVIDIA. These stocks on average were up 60% last year. Where the remaining 490 stocks in the index were up just on average 8. So as I'm sitting here telling you that the market had a great year, it's had a good run, you may be thinking in the back of your mind, well, my portfolio doesn't seem like it's keeping up with that, or the stocks I own aren't doing that. And that's probably true, because if you didn't own as much as those 6 or 7 stocks, you're probably not up 25 or 30%, because most of the companies in the index had just an okay year. Moving forward, though, we expect a broadening out to happen. It doesn't mean that those stocks that have done well have to go down. We expect the rest of the market to catch up. As interest rates start to come down, as we see growth in other areas of the economy outside of just technology like AI or weight loss drugs, those are big trends that we saw in 2023. They don't last forever, and they're expensive. There's other parts of the market that can do well, especially moving into where we believe we're headed. So bottom line, the S&P's had a good run, but it's really been driven by 6 or 7 stocks. The final point I want to make about the stock market is it's normal to have pullbacks. We very well could see some volatility over the next couple months if maybe the Fed doesn't cut rates in March. The market's kind of hoping for that to happen, as we've talked about. But let's say they say, nope, we're going to keep rates higher for longer. We're not cutting in March. We're not going to cut till maybe June or the fall. You could see a 5 or 10% pullback, or maybe even more at any time. Maybe something happens over in the Middle East or things get worse. We're seeing some concerns around shipping. 25% of the world's oil comes through a very small strait, the Strait of Hormuz. We've seen some attacks on cargo carriers. If that escalates even further, you could see dislocations in energy markets. So the point I want to make is, and I think I've showed this slide at every one of these meetings that I've been at, is don't panic when the breaking news happens. Expect it to happen, because every year the market goes down at some point. What this shows, these red dots, are the biggest drops the market sees in a given year. They're the breaking news events. Every single year the market goes down. Every year there's a red dot. The point is, on average, every year the market goes down about 14%. It's normal. It's not breaking news. The key thing is if you don't panic and you stay the course and you stick to the plan that Compass has put in place, 33 out of the last 44 years, the market finishes positive. That's more than a 75% chance. If the market was a baseball hitter, it would be the best baseball hitter of all time. The challenge is you've got to go through that period where the market kind of punches you in the gut, where you lose 10, 15, 20%. Doesn't feel good at the time, but it is normal. You don't want to make that emotional mistake to get out. Because if you get out, you've got to make the decision, when are you going to get back in? And that is, I think, oftentimes a harder decision to make. So again, while we're optimistic for 2024, like every year, there's something that comes along that spooks investors, that spooks the market. But again, it's perfectly normal. And as I mentioned at the beginning, Compass having that plan, you're not all in the market. There's other things that are acting to help protect you and maybe even take advantage of that market fluctuation when it happens. Two last slides. Obviously, an election year, and I don't want to gloss over that. And we just got done with the caucuses here in Iowa. We'll see what happens through the course of the year, but it's always, in heightened volatility. There's always heightened emotions as it comes to an election year. And the point I want to make is not asking you or telling you who I voted for or who you should vote for, or what might happen, because nobody knows. But there's a lot of research out there, but the main point is, while politics matter personally, it's really not impacted long-term around how the economy does or how the stock market does. If you look at the facts over the last 70 years, the gray bars show divided government. The blue bars show when it's a Democrat president, like we are today, a Democrat House, a Democrat Senate. That would be the blue bars. The red bars is all Republicans, and the gray bars, as I mentioned, is divided. You can see that the economy is grown in all three of those scenarios. If you look at how the stock market does, up about 13% on average when it's all Republicans. And that's the best, actually, but that's only happened about 10% of the time over the last 70 years. Democrats, about 9%. That's only about 30% of the time. The majority is about 60% of the time divided government, and that's still up over 8% per year on average. And so while you may have your candidate that you want to win or you want to see in, ultimately in all three of the scenarios over time, the economy grows, companies grow, and as a result, the stock market grows. And so if I could say nothing else on this slide other than, don't let the way you feel about politics overrule how you think about investing. You can have your opinions, but don't let that be the reason you get out or get in based on who's in office, because ultimately it really doesn't matter for the markets over the long term. The final thing I would just say is have that longer term outlook. Well, last year was a good year. We'll see what happens this year. But what we know is for investors that stay the course, they're rewarded over time. We'd love investors to have 20-year horizons. Now, sometimes people say, well, I don't have 20 years. I don't buy green bananas, right? But you got to be careful of the short term as well. What this is saying is over a 1-year period, going back to 1950, stocks could lose 39. They've done as good as positive 47. Who knows what can happen? It's a wide range of outcomes. Bonds, we saw it 2 years ago, lost 13%, as good as 43. And in a 1-year period, a diversified portfolio, the worst it ever did was down 20%. I'm sure you've heard your team of advisors say that you're diversified. How many of you would be happy if you gave them $100,000, they said you were diversified, and a year later they gave you back $80,000? Right? Probably not very happy, but that's over a 1-year period. If you have money on the sidelines or just money invested, you don't always just have to look at 20-year or 10-year horizons. Look at the 5-year rolling. What this is saying, this positive 1% right here, I think this is really powerful. If you're in a balanced portfolio of about half stocks, half bonds, never over the last 72 years, if you stayed in for 5 years, did you ever lose money. Doesn't mean you couldn't lose money over the next year, but if you stay in over that 5-year period, the worst you did per year was average 1%. Now, the same is true with sitting in cash or CDs, that you don't lose money, but you don't get anywhere near the upside of up 21 or up 9 that historically, on average, a balanced portfolio would did. And so to put it all together with all the uncertainty around the economy, interest rates, the markets, there's a lot of things to be concerned about, but I also think there's a lot of things to be optimistic about. The economy is growing, the consumer's healthy, interest rates are starting to come down, and company earnings in companies are doing quite well. But the key thing with all of it is to have that balanced approach and have that longer term horizon. And I think if you do that, you'll be just fine. So I'm going to pause there. Guy and I would love to take any questions around topics that we covered or maybe things that we didn't cover that are on your mind that you'd like to get addressed here this morning.
I'm going to talk for about 10 minutes here on a couple other topics and make a few comments on what Dan was talking about. So the Magnificent Seven, I just read LPL came out with some insight on the Magnificent Seven companies and said over the coming year, those 7 companies are expected to grow their earnings about 35% each. Okay, so these are companies, again, Apple, Microsoft, Amazon, Tesla, Facebook, NVIDIA, who is a chip maker. So again, those companies have, at least the market thinks, great growth opportunities. The rest of the market, the other 493 companies, they're expected to have negative 1% revenue growth over the coming years. So when you hear numbers like that, it's no wonder those companies are the ones that are going up and driving the gains of the whole market. So just an interesting tidbit there. Another piece I want to add to what Dan talked about is the credit card debt. And I actually KCCI came and interviewed me about credit card debt. And when I dug into the numbers, it surprised me. And the numbers came out is households with less than $50,000, they're not using credit cards much. It's the households over $100,000 that is where all the new credit card debt is going. And so those people have good incomes, those families have good incomes, but they have this slug of spending around the holidays that they say, hey, I can handle that, later in the year, just give me some time to work it off. So you're seeing delinquencies going up, but that's not actually affecting new credit card use. So the numbers that I dug into are actually pretty encouraging. The people that are adding some credit card debt actually have the income to pay it off. We polled some of the people that we work with in other industries. I want to talk a little bit about farmland. I want to talk about real estate in the metro. I want to give you a banking update, an insurance industry update, and a little tax update. So again, these are from professionals that we work with. So the first one is the farmland survey done by Iowa State University for 2023. Over the last year, average prices were up about 3.5% for farmland over the entire state. Of course, there's a lot of regionality in farmland prices, right? Northern Iowa and northwestern Iowa tends to be the best farmland in the state, and it slowly gets lower and lower quality as you move south and as you move east. High quality farmland was generally flat over the last 12 months at about $16,900 per acre. The best farmland in Iowa, some of the best farmland in the world. Low quality farmland, at least from Iowa standards, was up to about $7,500 per acre last year. Okay, so it did see a little bit more growth than the best farmland. Higher interest rates throughout 2022 and 23 did weigh on the market last year. Of the sellers, 57% are estates. And estates are people that have passed away, and then the executor is selling their farmland, or their kids are selling the farmland. The other biggest seller is retired farmers at 25% of sellers. Now the buyers are overwhelmingly existing farmers. At about 70% of the buyers are existing farmers. And about 25% of the buyers are investors, and typically local investors, not big pensions from out of state or out of country or anything like that. The outlook is, again, they're polling people that deal in farm real estate. The outlook is a flat year for 2024 for farm prices. However, overwhelmingly, people that they polled, farmers, sellers, buyers, do expect higher prices in 5 years from now, so 2029. Little update, if you want to read the whole report, you can go out and find it, ISU Farmland Survey for 2023. Residential real estate, taking a look at the Des Moines Metro. Homes sold in 2023 were just a touch over 13,000 in the whole Des Moines Metro. And by metro, I mean it includes Norwalk, Carlisle, Bondurant, right, Ankeny, so a pretty big swath of communities here. So over 13,000 homes sold in 2023, which was a 16% decline from the prior year. So home sales, the number of home sales are down. The median price, however, is up. $295,000 was the median price. That's the middle price of all those homes sold, which was up about 9% from 2022. The days the house sat on the market for sale was actually up also. 72 days on average, a house sat for sale before it was sold in 2023, which was up 38% from the prior year. Okay, so it was taking a little longer. The houses cost more, and there was less houses for sale and less houses sold. So it was a slower market as far as listings go. It is still a seller's market due to the reduced inventory. And what's happening is people are staying put because of their low interest rates, right? Even a couple of years ago, you could get a 3.5% interest rate on your mortgage. So unless people have to move, they're generally not moving, which means that there's less houses for sale, and that drives prices up. The lower end, I would say $300,000 and below is quite a hot market. Those are kind of considered starter homes these days, amazingly enough. And then, of course, as the prices go up in the 4s, 5s, 6s, 7s, and beyond, it's all very locally driven. You know, is it a great place? Is it in a good school district? Things like that. So there's a lot of pent-up demand. The general outlook is that prices are going to stay high and go higher. So that's kind of what's going on in the Des Moines Metro real estate market. Banking update. Let's rewind about 10 months ago. Anybody recall what happened in March of 2023 in the banking world? There was, it was called Silicon Valley Bank, and it went bankrupt. I shouldn't say that. There's a bank run at Silicon Valley Bank that lasted about a week and ended up with the bank going under. And the FDIC, that bank going into receivership for the FDIC. And in fact, what happened was that that bank had a lot of uninsured deposits. And what I mean by that is the FDIC is a government organization that insures your money in its member banks. And Silicon Valley Bank was a member bank. So if you had up to 250,000 in that bank, guaranteed by the federal government. But what happens if you're a business and you had $1 million in there, or some of these businesses had $2 billion in this bank, an enormous amount that was uninsured. Well, what happened is the FDIC stepped in and said, we're not only going to cover the first 250,000, we're going to cover everything. And why do they do that? Because banking runs on banks can spread. And this one spread so quickly because of a little thing called Twitter. They said, hey, the message started going around Twitter. If you're in Silicon Valley Bank, get your money out because it's going down. And so every day, billions and sometimes tens of billions float out of this bank. At some point, they run out of money to give out because they don't have all their money on hand all the time. That's how a bank works. But generally, so that passed, and nothing's really happened since. And everybody's kind of waiting around thinking, is there something we don't know about? Is there something going to go on? Because banking things they can spiral, right? That's why the FDIC stepped in and tried to stop this in its tracks. But generally, the consensus is that there is no pending bank crisis right now, simply because the government won't allow it to happen. Okay, that's the general consensus right now. But banks find themselves in a peculiar situation. They are collecting 3.5% interest on mortgages and paying out 5% interest on CDs. Not a great business model right now. And another thing that they're battling is during Dan talked about the big bad year in bonds, 2022, right? Way down. Well, a lot of banks own bonds for their assets. So the value of those, at least on paper, went down during the year. And so they're struggling in that area. But the idea that more mergers are coming, so you're going to see some mergers. I think there was a little Iowa bank that ran into some troubles. There was an Iowa bank branch that got sold, right? So some things are going on, but I would say from a big perspective, a lot of experts think it's well under control. So that's the banking update. Insurance update. I would ask you, well, we're all connected with the insurance industry right now, right? Number one, from Des Moines Metro, it's a very popular place for insurance companies to have their headquarters, so there's a lot of employment here. Secondarily, we are all policyholders, right? We all have our homes covered and our cars covered and things like that. Insurance industry is going through a real upheaval right now. And what's going on is for many, many years, the insurance industry has been losing money. Now, here's what's coming. Rate increases from 20 to 50%. Pretty much across the board. And here's why. Again, insurance companies own a lot of bonds too. And the value of those bonds went down sharply. So the insurance company's investment income is down. Guess what else is up? Hailstorms are up. Windstorms are up. Remember the derecho? It's actually been 2 or 3 of them since the big one that went across Iowa. It caused millions and hundreds of millions of dollars in property damage. Okay, so big storms are up, hurricanes are up, wildfires are up, all across the country. And so natural disasters are up, inflation is up. It costs a lot more to repair cars, costs a lot more to repair property than it used to. Also, on liability claims, like if you hit somebody with your car and injure somebody else, think about medical costs. Those are way up too. So there's a lot of factors coming to bear on the insurance industry, and they are finally taking action and saying, hey, we can no longer lose money year after year. We're going to correct this with the proper rates. So we're all going to see an increase. Keep your eyes out for it. Companies are also taking steps like pulling out of states. Now in Iowa, we have a lot of companies here that are willing to insure us, but in California and Florida, Not necessarily the case. So for instance, something in Florida that used to cost like a house to insure for like $8,000 now costs $20,000 a year. Right? So think about that. That can become unaffordable. And some people say, hey, I can't afford that. I'm going to go without insurance. Right? And there's a big risk too. California, the wildfires, they've been raging for years. Every year there's huge wildfire losses. Same thing, companies are pulling out. So that's what's going on in the insurance industry. They will get it right because they have to. And we do need the insurance industry to stick around. So just keep your eyes out for what's coming. 2024 taxes. And let's also rewind a year ago. I'm going to talk mostly about Iowa taxes. Rewind a year ago, there was a new law starting in 2023 for those over 55 taking income from their qualified retirement accounts became a 0% tax rate in the state of Iowa for retirees. Pretty awesome. Okay. What we found a lot of is people didn't adjust any withholding. So if you didn't adjust your withholding last year at this time on your retirement account distributions, you might get a big Iowa refund, and you might want to think about it from this point going forward. Also, what happened is the same law that created that 0% tax rate on retirement income also said we're going to step the Iowa rate down over the course of several years. So in 2022, it was close to 7. In 2023, it was going to be close to 6. 2024, it's scheduled to be about 5, and it was going to keep stepping down for another year in 2025 down to about 4% for Iowa income taxes. Well, I don't know if anybody paid attention in the most recent State of the State address. Our governor said, we'd like to accelerate that and try to make the end rate in Iowa 3.5%. And we'd like to do it this year. And by that, I mean retroactive to January 1st of 2024. So a lot going on there. Be talking to your CPA. We do recommend you be in contact with your CPA about these sorts of changes so you can make proper withholding. So you can pay what you need, but not pay extra, okay? That is generally it on those topics. So I do want to welcome Dan back up and open us up to questions. Sort of questions for Dan or myself. We have any online questions, Caleb? Nothing yet? We would welcome, sorry, hold on. No. You got to speak into this for online.
So I'm curious with what you said about the S&P 500 with the large percentage of stocks in the S&P 500, struggling with earnings growth. Dan, specifically, do you have a sense of whether small caps, mid caps, or large caps on the growth side or value side go to the style box, as we note in our industry? What sector of the stock market do you see the most potential?
Yeah, so that's a good question. When we think about the larger companies, you think about the household names, those are the companies that have done really quite well, not just the Mag 7, but even outside of that. It's the biggest companies that have done the best. The challenging part of the smaller size companies is they tend to have higher levels of debt, more higher levels of interest rate, and also they tend to be more economically sensitive. If the economy goes into recession, those are the companies that get hit the hardest, and they can't always pass on price increases to their larger counterparts when they, trade and they, sell their goods. And so the concern with those small companies is they are very attractively valued. We do see opportunity in them, but if interest rates stay high, there could be some concerns there, or if the economy slows more than we would expect, maybe some concern. But I think, definitely some opportunity, but I think you want to be a little bit cautious there. Outside of just the small, even in the large cap, we still see opportunity. We like the Magnificent Seven, but there's quality companies that are growth and quality companies that are dividend or value that aren't in that Mag 7. You can still make money. And maybe the earnings do slow, as Guy and LPL Research shows, but maybe they're not trading at such a high premium that they're on sale. You can find some pretty good buys at the store if you look in the right spots. It's the same way with the stock market. They don't always have to be that household name or that exciting stock or have AI in its name just to do well. Good quality businesses that raise their dividend over time, that've been around for decades, that's been a pretty good historical business model and stock picking approach as well. So that's a good comment.
Yeah, it has been. One of the risks with those biggest companies is you're starting to hear the government antitrust divisions start to look into these big companies.
Yep.
And there's, Google, some people think Google has a monopoly on internet search, right? Some people think Facebook buying competitors like Instagram is anti-competitive. You see a lot of those things starting over in Europe, and the idea is coming here now that maybe these companies are too big. And if you recall, probably 10, 15 years ago, Microsoft went through the same thing. They got in trouble for putting their own web browser preloaded onto their own computers. So what I'm saying is it is a risk out there that these companies might get broken up or might be told, hey, you can't buy your competitor out, right? In fact, JetBlue and Sprint airlines were just supposed to merge, and the government said, we're not going to let it because we think that'll decrease competition and hurt the customer. So there are those sort of things going out there, even for the biggest companies. Well, I should say especially for the biggest companies. Other questions? All right. Well, thank you, Dan, for joining us today. Thank you all for your support, and thank you for coming. Yeah. Compass Advisors will all be here. Mix and mingle. Enjoy your time today, and thank you for coming.